Hi, everyone. This is Jason Bierek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast. Today, instead of a normal interview, what John Manfreda and I are going to do is we're just going to do a special on the precious metals, on gold, silver, maybe touch a little bit on platinum and palladium too if we have time, and also talk about the mining shares. So what we're going to do, John, is we're going to break down all the different components that go into the market sentiment. Into the market in general. So we'll talk about the technical picture for gold and silver and the mining shares. We'll talk about the real supply-demand fundamentals for gold and silver and how that affects the miners. We'll talk about the miners' production costs. And then we'll talk about the market sentiment, too. So let's get started first with the technicals. John, the technicals picture here, I mean, last year we did a lot of podcasts. We interviewed a lot of technicians. We interviewed Jordan from the Daily Gold. We interviewed we interviewed Turt Ferguson, and on the paper prices on the gold and silver side, and also on the GDX, which is a large gold miner index. There's other indexes too. From July to August and September of 2012, there was a really nice double bottom put in on that long-term chart. It was just a beautiful W, which is a reversal pattern, which means that we were ready for a breakout. And you saw, if you look at the chart, you saw a really beautiful breakout pattern there. You saw after the W was formed on the double bottom, you saw a cup then and a handle, and the breakout started, and then it just got smashed down. And it's gotten smashed down basically since. And there's been a number of times, John, I don't know if you watch the paper prices every day, but there was a number of times, too, where gold and silver, at least the paper prices, tried to break out, where silver tried to break out above 32, and I think gold tried to break out above like 1660, above 1670 levels to test 1700, and it just got smashed down. And now, in the last week or so, or 2 weeks, all the support levels that it was at on the charts have just broken. So what's your opinion of this, John? Do you think this is free market forces here, or do you think there's, the central banks and the high-frequency traders and all that are they don't want the gold price to rise, and the Bank of International Settlements is involved?
Yeah, it's definitely not a free market. I watch the price every day for my day job in the industry, and this always happens. In the futures market, it's lighting up. It's ready to break out. It opens higher, and then somewhere between 10 to 10:30, it just gets smacked down. That's been the reoccurring theme. In fact, Friday morning, gold was up around $4. Silver was up 20 cents. Silver barely finished above at 7 cents. And gold finished down $4 or roughly $5. And that's been the theme. And you can just tell it's some engineered price decline. There's no way that this is normal. And you can tell it just wants to break up, as you said about that cup and handle. It wants to break out. It should be breaking out. And the Fed minutes, I think, was designed solely to manipulate gold and silver. I've never seen a Fed minute type ever get that publicized before. It was solely designed. And then Bernanke went back and said it didn't have his official endorsement. That's just pure blatant, bait and switch and propaganda and manipulation.
Yeah, I mean, they're not going to stop the stimulus in the QE. There's no real exit plan. I mean, the BLS can make the statistics look better than they really are in real life. They can not count people who stop looking for a job or who are underemployed or whatever, right? So,
mean that's unemployment's more than 7%?
Yeah, of course. It's probably at least double that. But in terms of the technical picture, I'm looking at some other chart work, and the funny thing is, for our listeners out there, there's been a lot of good, and this is more proof that this is not a free market, John, in my opinion, is that we have really good technicians. You have Gary Savage of Gold Money Tracker, I believe, and Gold Sense. I think he also goes by Toby Connor. And then you have Jordan of the Daily Gold, who's also a very good technician. And these guys have been, for at least 6 weeks, they've been saying the bottoming process is in effect. Gold's going to hold very strong support at 1580, and it didn't hold at 1580 really. The next level of support for gold on the charts there is it has very strong support in the 1550 levels. And then the last support level there before things are really going to get dicey on the technical charts is the 1525 level. If things break below the 1525 level, things are going to get very ugly. I mean, the things are going to get very ugly in terms of like more and more oversold. Because, John, isn't all the hedge funds are all short, according to the commitment of traders, according to the relative strength indicators on the technicals. Gold is massively oversold. I mean, especially on the commitment of traders, all the hedge funds, the small guys, are all short gold on the paper price, right?
Yeah.
With leverage.
Yeah, that's true. I actually read somewhere that I think it was Ed Steer, because I read his daily update, or his market morning wrap, and it wraps out the day before. And the funny thing is, they keep adding to the short positions, yet no one's willing to pick them up. And he actually claims that what I've been reading is that a lot of hedge funds now want to get out of it because they think gold and silver is undervalued, but no one's willing to pick up their shorts. And speaking of like technicians and everything, Greg Manarino, who is one of the best, especially when it comes to short term, he doesn't even read the charts of gold and silver anymore because he says it's so manipulated that you cannot predict day-to-day swing movements in the gold and silver anymore, because you never know, what type of engineer they're going to design.
Yeah, and that's a top trader who's very good at reading the charts and very good at looking at all the indicators. Greg's a former head floor trader for Bear Stearns, and this guy, he's one of the best, and he doesn't even want to touch the trading market for the most part. He just, when there's a big, paper price smash, he just buys more physical from his trading profits and other stocks and other ETFs and stuff like that.
Yeah, he's, in terms of trading, this is the guy, he's the top 1% of the top 1%. Yet he's like, I can't even think of trading in gold and silver right now.
Okay, so, well, I think we cover the technical picture for our listeners here. So, in terms of the relative strength, gold is massively oversold. Now, things can stay oversold for a while, right, John? Things can stay oversold for a while, but there's still some support levels in the 1550 range and at 1525. If things drop below 1525, I think that's a really good time to hopefully our listeners are taking more of a long-term approach to being gold silver investors. I know they're upset at their mining stock positions. Even Sandstorm Gold was down 20% in the last couple weeks. It's still languishing here for literally no reason. I mean, the gold price isn't even down that much, and the market might not have liked the Entree Gold potential Goldstream deal, but that's not 20% of Sandstorm Gold's market cap. That was a Bladenova reaction. So I just think here things in terms of a sentiment level were massively oversold. It's very negative. In my opinion, John, like I don't know if you were around in the gold and silver market and buying things either before 2008 or after the 2008 market crash, but I have not seen things this bad. And I could actually make an argument that things are actually worse sentiment-wise than they were in 2008.
Yeah, I actually paid most attention to oil. That was like my main passion. I didn't really become involved in gold and silver till late 2009. It was actually, the funny thing is, a guy who I don't even like anymore, Glenn Beck, actually introduced me to gold. And that's actually propped the idea, and I was like, this might be a good idea. And I was like, I knew things were screwed up and messed up, and I was like, this might be a good thing, because, if political instability occurs, this is the best hedge towards it. So, but sentiment's horrible. You even got people like Peter Grandich saying, I don't, Mo interviewed him the other day. He didn't seem too enthusiastic about any short-term fluctuations. He says long-term it's a good investment, but...
That's because, John, in my opinion, I think he's too far out the risk curve. The way the market has changed, I think he's in juniors, way too risky at juniors, at junior explorers. I think this market, you gotta, in terms of where you're putting your investments into gold and silver, you obviously have to have a certain amount of bullion for insurance and wealth preservation. You have to have a certain amount of percentage if you're going to own gold and silver shares. You have to have them in the royalty and the streaming companies first. And then, you got to have them then another percentage in the companies that are actually earning money, or have, if they're not earning money, even at these prices, they have to have all their financing. They have to have a pretty good balance sheet. They cannot have a humongous amount of debt. They have to have all their financing, like I said, preferably like maybe they put cash in the bank, or maybe they dilute it a little bit so they can put their mine into production without a humongous debt overhang. Like a Colossus Minerals or one of those types of companies that's very close to production.
Well, I was also going to say Porter Stansberry is even getting, he is a massive gold bull, and I saw him spoke live in October, and he was saying how gold and silver, you can't go wrong with that. He's like, and if you want something safe, that's definitely what you buy. He's even getting discouraged. So we're definitely near bottom, if you ask me. Very close to it. If it goes down another $100, I'd still be surprised. But
well, let's talk about since we talked about the technicals and we talked about the sentiment levels and how things are as bad or worse than even 2008. Let's talk about the fundamentals now, the real supply demand of the market, and maybe the divergence in paper prices. And then we'll talk about how the miners are doing actually from a fundamental standpoint and why the price can't go much lower without the miners, starting to go bankrupt or postponing or canceling production. Okay, so first now let's talk about the real supply demand fundamentals. I don't really see anything coming out. I don't see investor demand, especially globally. I have not seen any stories saying investor demand out of China or India or anywhere else has dropped. And I don't see anywhere else saying that central banks, China or Russia or any of these guys have stopped purchasing any bullion. In fact, John, you have Germany, you have the Swiss, and you have Mexico now, and I think there's other smaller countries, right, who are demanding full audits of their gold and trying to repatriate all their physical gold, right?
Yeah. Venezuela was the first, but a lot are doing it, and Putin is buying like mad, and he's even bragging about it. So there's definitely a higher demand. I'm seeing more Americans buying gold and silver. In fact, the U.S. Mint had to suspend sales, and the Royal Canadian Mint had to. So there's even North American scarcity. So the demand is just huge.
Yeah, I think the investor demand globally is still increasing. Now, maybe some American investors are discouraged here and people are scared to buy when there's blood on the streets because it's very difficult to be a contrarian. I mean, hindsight, it's always looks easy. But, after the 2008 crash, I had not bought any physical gold or silver or any gold or silver mining shares prior to the 2008 market crash. I just started researching things, and when I saw the big drop and I saw how cheap things were, and then I read how, for sure the Fed was going to print more money, I just started buying then, and I bought when there was blood on the streets. I bought Coeur d'Alene, and it went up tenfold. At one point, it went from, after accounting for a reverse split, it went from $4 a share up to $40 a share at one point. And I was buying physical silver when it was $12 to $14 an ounce range. So, that's pretty good. It required a lot of discipline. I had started reading a lot of investing books back then. That's when I had started reading like Warren Buffett and Benjamin Graham contrarian stuff. Now, I know they don't like gold, but their contrarian value play still applies to being a contrarian in the resource sector. And, it paid off then, and I made a good amount of money on a good amount of mining stocks. And, I wish I'd bought like Silver Wheaton when it dropped to $3 a share, but I didn't know a lot about the gold and silver mining industry, not nearly as much as I do now. And I just see tons and tons of bargains out there, and the real supply-demand fundamentals of this market continue, in my opinion, to improve. I see investor demand globally increasing for gold and silver. I see central banks, what they're net buyers now of gold. They have not been for a long time, up until the last couple of years. And now what you said, what China and Russia are now putting over 50% of their trade surpluses into gold, physical gold.
Mm-hmm.
So I just see positive supply-demand fundamentals, and there's a big divergence, right, in the paper prices, which is just shocking. So what, in your opinion, John, and we can talk about the miners now, and this is where I think why we're going to hit bottom. If we did have a gold move down, if gold broke the support level of 1525, if gold stayed below 1525 for 3 months or 4 months, you would have a bunch of gold mining companies postpone or cancel production, right? Because let's talk about production costs now for the miners. These guys are not, their margins, a lot of them are not that good.
Yeah, you see a lot of production cost, and the funny thing is, I think it was Goldcorp or Newmont. I think all the majors had to redo how they calculate cost because they actually understated cost, and you're seeing a lot of them go to $1,200 or 1,200 per ounce of gold, and they'll have to, if it goes down to even 1,400, a lot of projects would have to be canceled because of the cash cost. It's getting too, the grades are depreciating.
And they're using more energy, yeah.
Yeah, and not only that, oil prices are going up. You didn't see much of a correction in oil, so that will hurt their margins too.
And their labor costs are going up. The taxes and royalties from foreign governments are increasing because they see higher and higher paper prices. So these are not going to help the gold and silver companies that are in certain countries with their margins at all. There's margin compression. And if I could add more to your point, you mentioned the larger companies. And Goldcorp which is symbol GG for our listeners, on the New York Stock Exchange, they are considered one of the lowest cost producers in the entire industry. And they recently came out in the last couple weeks in a new PowerPoint presentation, and they disclosed all of their different costs, right, that go into an ounce of gold into their production, whereas normally in the past a company would fudge some of their production cost numbers and say that their cash costs were only $400 an ounce or something like that, which I don't know if Goldcorp had done that in the past, but other companies have. And anyway, though, Goldcorp came out and said that in 2013, their all-in production costs are going to be $1,100 an ounce. And Goldcorp is considered one of the lowest cost producers, John.
Yeah.
So I think that shows that the miners, even though the precious metals price in general, we're still in a long-term secular bull market. We've had a cyclical bear market now, which for listeners, and that's a technical analysis term. Cyclical means a shorter term. Secular means a longer term. So we've had a shorter-term bear market within a long-term bull market, and the miners, their margins have just not done very well. Now, I think the average production costs for the many gold miners across the board, because of all these input cost increases, they're mining, like you said, John, lower grades of gold. In order to mine those lower grades, because there's a lot more rock in each ton of ore than gold, their production costs are going up because the grades are lower. There's some of these deposits are not near infrastructure, so they have to truck these things miles and miles to the mill. So all increasing expenses, because the deposits, are not near infrastructure anymore, a lot of them. They're not super high-grade gold. So the costs are just going to keep going up and up. So eventually the miners are just going to say enough is enough at one point if gold stays below 1,500 for a month or two, and they're just going to cancel or postpone projects. And it's a similar story for silver. In silver, I think the all-in production cost you have for Silver Standard, I read an article, that Silver Standard, and they've been in production at Pirquitas for about 2 years now. They haven't hit any of the production guidance for that mine. It's been a disaster. And their all-in production costs, John, are $20 an ounce. They can't make really any money at all. So I'm not saying that's the production cost for all silver miners, but I mean it's the same type of deal in silver, where a silver mining company really can't make any money at $25 an ounce silver. Many of them.
Oh yeah, definitely. And not only that, in terms of how much production can increase, financing is really horrible with the juniors. A lot of them can barely get financing, so a lot of these projects. And since the large cap miners aren't making any money, it's hard for them to even get bought out, even if it's pennies on the dollar. That's why you haven't seen a major consolidation like you would see in a normal consolidation or cyclical bear market with the oil and gas industry. When prices went down, you saw it with PetroChina. They were buying out Nexen. You see so many, Exxon bought out XTO. You don't see too many. You see First Majestic, they tried to buy out Orco. CDE ended up buying them out. Oh, excuse me if I mispronounced it.
Coeur d'Alene, yeah.
Coeur d'Alene. But you don't see many consolidations. You don't see Yamana brought out Extoria, but you don't.
Yeah, that was a good deal for Yamana. And First Majestic, like Keith is just Keith Newmeyer for our listeners, the CEO of First Majestic Silver. He saw how cheap the assets were. They had good cash flow. First Majestic did, even at these silver prices, because he does a great job keeping costs down. And yes, he didn't get Orco Silver, but at least he was aggressive enough to put in the bid. But he did get Silvermex, though. He bought out Silvermex, too. So, there's just not many management teams who have been doing that because a lot of the management teams, John, especially from like Newmont and Barrick and Goldcorp, some of them, well, I don't know about Newmont, but I know Barrick and I know Goldcorp. Some of them made really bad acquisitions, especially Kinross and IM Gold and those guys. They've made some really horrible acquisitions over the last 2 or 3 years. They tried to they tried to have growth for growth's sake. They drastically overpaid for assets in the ground, and now they're paying for it. And some of them, the management teams have been completely displaced. The CEOs got fired because they weren't running their businesses efficiently. And for an example like that with Barrick, you have Pascua-Lama, right, which is this massive gold and silver and copper deposit straddling the Argentina and Chile border, right? And when Barrick bought out that deposit, right, they're initially projecting CapEx, I think, to be only $1 or $2 billion, right? This was only a few years ago. They were projecting CapEx to be $1 or $2 billion, and the projected production costs as they've been building the mine, John, have gone up to $8 billion. That destroys the internal rate of return or return on invested capital of the project. That just destroys the profit margins. The only way to overcome that high of production cost increases, as you know, John, is for gold and silver to go drastically higher.
Yeah, well, definitely. Definitely. It's really, and that's one thing, is we can see major shortages if we don't get a higher price, because a lot of these companies, if they don't go into production, these juniors, they're not going to go into production, and these majors, they overpaid, and they're not going to be able to, they're selling out a lot of non-core assets.
Yeah, the large companies, John, not only are they firing their CEOs because the CEOs haven't, paid good dividends, they haven't done things that are efficient for shareholders, they haven't gotten a good return on invested capital. Some of them haven't even gotten 10% return on invested capital. Their return on assets are horrible. So I think that's the way that the focus of the industry, especially for the large producers, is going to change. It's going to focus to paying out dividends and being efficient and things like that. And these new CEOs, John, of those companies then are going to be very hesitant on acquisitions then. They're going to make sure they don't overpay.
Yeah. Well, not only that, the good news about the miners, one thing that makes me more bullish, is that at the conferences, a lot of the management teams were getting grilled and seriously crucified by investors because they're so mad that they're underperforming gold and silver. And that's
not only have they underperformed gold and silver, John, a lot of the companies, and this is not every company, because you have a quality company like Sandstorm Gold or Silver Wheaton, which have drastically outperformed their underlying bullion. Because, the business models, those are just capital-efficient businesses, and their business model is so amazing, right? But the general miners, the actual miners who do all the hard work. But, these guys have drastically underperformed the bullion, some of these miners, by more than 2 standard deviations. It's even getting close to 3 standard deviations. And for you statisticians out there, lagging a 3 standard deviation move, I think, is 97 and 99%, I believe, is mean reversion, right? So the odds of something, being 3 standard deviations or more away from something and staying at that trend are like extremely low. The odds favor then a mean reversion back to the mean.
Yeah. Well, another thing is, in terms of gold and silver, one of the biggest underreported stories I read about is a lot of people are wondering why they can't get silver is at 28, but they're paying a lot more for it, and they can't get, they're paying $4 to $5 over spot, and they can't get, bullion that close. And the reason why is the paper price and the real price are completely, distant from each other.
Yeah, there's a divergence. Yeah, it's the real supply-demand fundamentals and the price you pay at the bullion dealer are the reality, right? Yeah. And the paper price is not part of the reality. It's drastically short, despite some of the fundamentals of the market, which are obviously improving.
Yeah. Oh, I'm hearing so many stories of people going to coin shops and there's just not any there. I remember calling up a coin shop. I was asking for maples, and I was going to buy like a couple of maples. And they said, we're all out. And they thought I was talking about gold maples. And I was like, do you have silver maples? They're like, yeah, but we only have 1 tube. So if you want it, you got to get over here quickly. And And that's just the reality right now. There's a lot of shortages going on, and I think this is a free market force. Like, if
Now
they don't
doesn't
get
it
it
now?
in the paper price, they're getting it in the bullion price.
Now, John, since you do work at a bullion dealer, for orders, some orders that are six figure, over a couple 100,000 of gold or silver, is it still taking weeks to get those to fill those orders?
Yeah, definitely. A lot of places, shipments is delayed, and the thing is, it's very hard telling people like, yeah, we'll get you it, and you'll lock in this price, but you might not get it for quite a bit. And it's hard telling the customer that because they're not doing anything wrong. No one's doing anything wrong. There's just the shortages, and there's not a free market price to curb that demand, so people can get it. And one other thing too is Apple is actually having trouble. I read this in Silver Doctors, getting enough silver to fulfill their products, which is unbelievable. That's completely the mainstream wouldn't even report that, but if you read it, it's the industrial demand is even increasing.
Yeah, I don't know if I don't know if Silver Doctors was reporting that as a fact or if it was just a rumor. I'm not sure how substantiated that claim was. So let's just keep it that it was a rumor that. So I'm not sure how true it is or not. Anyways, though, John, I think we've addressed the technicals. We've talked about the sentiment levels being as bad as 2008 or worse, which is a good sign to be a contrarian and to, don't go in if you have a position already. Obviously, if you're a longer-term investor and you have some cash on the sidelines or more money coming in from a job, it's probably a good time to keep adding to positions to the quality stuff. And let's talk now about the quality stuff, how the market has changed. Obviously, in 2009, and you could buy almost anything when Ben Bernanke was pumping the market originally with QE1, everything went up. But in 2010 to April, really, of 2011, the juniors and a lot of the smaller gold and silver companies went up massively, hundreds of percent. We booked 400 to 600% profits on a lot of mining stocks, took some money off the table. Because, the mining stocks are just so volatile. In general, they're volatile. And, it was just smart. The companies had risen, over 400% in literally 18 months, and it was just smart to take some money off the table. But let's talk about then how the market has changed and investing in the gold and silver sector now. Obviously, I don't think you and I like juniors that much anymore. Now, if a junior has maybe a ton of cash already raised, like their management team was prudent, and, when gold and silver prices were higher in 2011, they raised all their money then, and they have, they raised 2 or 3 years' worth of cash then, and they're cashed up and they're fine, and they have a good deposit, like NI 43-101, pre-feasibility, preliminary economic assessment, advancing it to feasibility or something, maybe a couple good larger mining companies as partners. Those would probably be about it in terms of me buying juniors, junior explorers. But in general, though, I think this is smarter to not go that far out the risk curve. I think you can buy earnings and cash flow for cheap, right? Because Newmont's selling for barely 10 times earnings, right? And Newmont has over 4% dividend yield. So that's really solid there. Newmont has really good gold production. Their margins are pretty darn good for a large producer. There's not a lot of growth in Newmont's pipeline, so they're probably going to have to go do some acquisitions. But I think their dividend's very safe. It's a small amount of their payout ratio, and they have a really good dividend plan that they've already outlined, right, that when the gold price goes higher, they're going to increase their dividend. So I think that's a good dividend stock for listeners. This is not investment advice. Do your own due diligence, do your own research. But I think Newmont, in my opinion, is a very good long-term investment for more conservative gold investors because it pays out a good dividend. It's got some growth issues maybe, but maybe the new management team there will start buying more smaller gold mining producers and add production and reserves that way. And the other yield play, John, that has really good yield is Goro. And what the Goro's yield is 5.6% right now. That's a pretty fantastic yield.
Yeah.
And they have good growth, right?
Yeah, they're doubling production, and not only that, they have a share buyback program. So, and you can, if you want your bullion and dividends, you can get it in gold bullion or you can get it in silver rounds. So, if you want bullion and you want to just add to your bullion collection, you can buy Goro that way, and you don't have to worry about spot price or over spot premiums or anything. So that's a pretty good deal. I like Goro. I think it's a great buy at 13.
Yeah, I think so too. I think it's going to be a long-term winner, and Hawkschild already has a large position in the stock. We could see Hawkschild come in then and try to take out Goro at a big premium, and you're going to get paid then a dividend to wait. Hawkschild's already a large shareholder in the company, so there's probably the incentive there for them to want to make a buyout offer soon. I think that's coming, and then you have a dividend. But in terms of me and my portfolio, what I've been looking at doing, and I've put my money where my mouth is, and obviously things have not been very good as a gold and silver investor for a while, although we did have, for the last 18 months, Sandstorm Gold had been drastically outperforming every other gold stock. Even though the gold price had been correcting, had stayed flat for a while and then correcting, Sandstorm Gold was still up at one point 120%. It was drastically up. And it touched $15 a share at one point. It's now at a 52-week low. And their pipeline is even more stacked with more growth. They have a bunch of free cash flow. They have 3 new gold streams coming online at the end of 2015. That's more free cash flow for Nolan Watson to buy more gold streams. He is an amazing manager. And, if you can get Sandstorm Gold at $9 a share, it may drop a little bit below that. I've seen some technical analysis saying Sandstorm Gold could drop as low as $6.50 a share. I would love it, because I have some cash coming in now. I would love it for Sandstorm Gold to drop to $6.50 a share. But I am a strong buyer here around 9. And if it drops lower, I will be increasing my position even further, because I expect the gold price to. I know Sandstorm Gold is going to can make a lot of money even at these prices because their costs are fixed. And Nolan Watson is just one of those amazing CEOs that he knows how to generate. His business model is amazing. He's a hard worker. He's a good, honest guy. He's done what he says, and he has a track record to back it up. He did it at Silver Wheaton, and now he's doing it at Sandstorm Gold.
Not only that, you and Mo know Nolan Watson, so yeah, it's not just commentary. I haven't, but you two have met Nolan Watson, and I also think during this time, I wouldn't fool around with the juniors. I think one day, maybe a year or two, they'll be big cash cow, big growth gainers again. But right now, especially since a lot of people are down, I would just buy the good companies, the First Majestics, the Sandstorms, stuff that's going to rise 2 or 3 years from now. Juniors, it's still unpredictable, even the small midterms, but I think right now to average down, First Majestic, you can't go wrong with that. Sandstorm, you can't go wrong. Silver Wheaton, something like that, because they're going to rise. And Silver Wheaton, you get a dividend, too.
Yeah, true. And the real sweet spot in the industry for the regular miners, the regular gold and silver miners, not the royalty and streaming companies, is the junior producers and the mid-tier producers who have growth already in the pipeline, so the management teams don't have to go out and overpay for assets. Although assets right now are selling for pennies, but many management teams are just not aggressive and not doing deals. You're just not seeing the deal volume that I expected. I think maybe that could change, but I just don't know. I think a lot of it is because the banks, John, who normally would finance some of the M&A with some debt or some other creative financing, they're not offering the larger mining companies good terms to go and do those M&A deals. That would be my best guess.
Yeah, it's the best guess. I can't come up with any reason.
Yeah.
I think one also is bad management. They over-leverage, so... Generally, when you make that mistake, you're very, some people are just reluctant to go back into it.
And the management teams too, John, also like to overpay when the gold and silver price are higher, because that's what all the other guys around them are doing, and that won't get them fired. But if they go and they buy something, when prices are cheap, when prices are really cheap, they could get, no one else is doing mergers and acquisitions. That's when they get criticized. Whereas, Keith Neumeyer owns a large stake in his company. So his shares, his stake is aligned more with individual shareholders. So our listeners should look for that. If they can find a management team then who has a larger stake in the company, and that's the case with Goro too, where the owners own a large percentage of it. I think it's more than 10%.
Well, it's Silvercrest. They own 45%.
Okay, well, yeah, that would be the type of thing I would be looking for, where the management team, the owners, they're owners too in the company, they have a large stake incentive then to smartly and efficiently grow the company. So, in wrapping things up here, John, any last comments to say about the gold and silver market? I know there's probably a little bit more pain, but I think we did a good job outlining to listeners what's happening right now. When the bottom is going to really happen, we're going to have a bottom at that point, in my opinion, where the miners say, we really can't make much money here at these levels. We have deposits in production that can make a little bit of money, but all of our future growth plans, we're going to postpone them or delay them, or cancel them, or sell off the assets for pennies on the dollar, or write them down or something. And I think we're starting to see that to a little extent with Barrick, but it's not near enough for many of the companies.
I would just say my biggest advice towards anyone holding mining shares or in gold and silver is don't give up yet. There's nothing more painful than buying, you see a bull market, and then there's
buying high and selling low.
and then you wait out the correction. And then
there's nothing more painful than buying high and selling low.
Well, not just that, but you wait out the correction. And then you get so discouraged, you sell it, you just get rid of it, you're like, all right, this has been enough. And then 6 months later, it skyrockets again. If you just waited out that 1 or 2 months, you waited out for so long, but just 1 or 2 months more, and you just didn't do it. So there's nothing more frustrating than that. So just hang in there, I would say. You will be rewarded.
And don't buy if you're gonna average down and add to positions. Don't buy all of your position at once either. This is something with commodity stocks in general, because of the volatility, especially in gold and silver. It's not a free market; it's a manipulated market. Do not buy all of your position at once. So if you do your research and you see, Sandstorm Gold's amazing at 9, right? I do not want to hear any emails or comments or anything like that saying, but you said it wouldn't go any lower, and I put all my money into Sandstorm Gold at 9. I mean, it could go lower.
Well, you did say it might go to 6, so.
Well, I said there's a technical analysis saying it could go as low as $6.50 a share. I don't think it will, but I'm buying here at 9. I'm adding to positions at 9. If it goes lower than 9 and it goes to $6.50 a share, I will thank the market for a long-term value, because I know all the hard work and how efficient Nolan's going to take that money and reinvest it into more gold streams that are going to make the company a ton of money. And I think the market's just drastically overreacting to that Entree Gold deal in Mongolia, because Nolan negotiated the things into the contract, the terms into the contract, where at worst he gets his money back.
Yeah, dollar cost average is the best to play.
Especially with resource stocks, because those are going to be way more volatile than a Coca-Cola or a Procter & Gamble or a Johnson & Johnson. You're not going to those large stocks. You're really not going to have you're not going to be down 10-20% in a week or something. It's not really going to happen.
Yeah.
But in resource stocks, Sandstorm Gold was down 20% in a week, and there was really nothing wrong with the company, and the gold price hadn't dropped that much. So, it just happens. Anything else you want to say? Well, actually, I got one more thing I want to say. Is that, right now for our listeners, we were very big on juniors in the past, and the market has changed. Flat out, the financing market has changed. The capital that was available to juniors to go out and do their projects and get funded by either larger mining companies or by hedge funds or institutions or private equity or retail investors on private placements, a lot of that money is no longer available. So the market has changed, but things could change again to be in favor of juniors if gold and silver break out. So I don't know, when they're going to break out. I don't know when. I've talked about where the support levels are in the bottoming process, but we could be stuck like this for months, or it could be over by the end of next week. We just don't know.
Yeah.
So I'm not selling any of my core portfolio positions like Sandstorm Gold or anything like that, but some of my riskier gold mining stocks, the companies that are years away from cash flow, that have balance sheet issues, too much debt, or financing issues, I am selling those. Because, with lower prices, I don't know if they're going to be able to survive. They might be forced to sell out. They can't get their financing, and they're going to have to sell out their assets for pennies on the dollar.
Yeah. Yeah, I was just going to say, just always hang in there, and I was going to say also just gold and silver, the fundamentals are stronger now than it was in 2011, 2010.
Yeah, and look at how many QE programs have been done since 2008, and sentiment-wise, John, in the mining shares and for long golden, people who buy bullion and stuff like that, people are not, some Americans are not buying as much.
Yeah. Oh, and I was
So,
gonna say one other thing. If you're overweight gold and silver and you want to diversify into like consumer staples or anything, my opinion is, of course, you have to do your own due diligence. Some might need a more stable yield or whatever.
They should hire us for consulting because we do, besides resource stocks, we do dividend stocks too,
Yeah,
consumer staple
hire us
dividend
for consulting, but
stocks.
but
And we'll
also
teach them.
you
We'll
might
teach them how to do it.
rethink rearranging it till the next run up. Sometimes, generally, when you're overweight in something, you want to rearrange it after a run up.
Yeah, so yeah, I have been reorganized for our listeners out there. I've been reallocating my portfolio. What I've done is I've sold some of my riskier mining stocks that are years away from earning a profit or have had balance sheet issues. And I didn't go to all cash. In those positions I liquidated, I took the losses and I put more money into Sandstorm Gold. So I've been buying more Sandstorm Gold, and I've been buying other companies that are earning money right now, even in these times that are staying lean and mean and can make money during these difficult times. So our listeners, like, obviously we're not giving financial advice, we're only giving our opinion. But I think 2 to 3 years from now, I think we're gonna laugh at how cheap gold and silver were at these levels, because I wish silver Wheaton dropped back down to $3 a share. In 2008, people got the opportunity to buy silver Wheaton as low as $3 a share. And now, silver Wheaton's still over $30 a share, right, John? So
Yeah.
it's just, yeah, you made 10 times your money buying when there was blood on the streets and there was panic. Being a contrarian, yes, the silver Wheaton's just under $32 a share. So just stick with it. Keep a longer term view, and the best time to buy physical bullion and gold and silver companies is when the price drops, is on big smashes. Don't chase the price higher. Don't because the manipulators are still in the short term. They're still controlling the market. In the long term, they cannot control the market. They can only manage the retreat.
Hmm.
And I guess that's wrapping it up. So for listeners out there, hope you enjoyed this. Think we covered pretty much everything we wanted to cover about gold and silver. And if you want us to help you, educate you on the gold and silver market, when to buy bullion, where to store it outside the United States, how to value gold and silver resource stocks, how to do research on dividend stocks and other consumer staple stocks, you can check us out our work at wallstreetformainstreet.com, which is WALLSTFORMAINST.com. And we do consulting work by the hour, either locally here in the DC metro area, or we do it online over Skype or other video conferencing software. And I'm sure we can help you. We have dozens of satisfied consulting clients. And hopefully we'll hear from you soon.